Jay, thanks for your time. Happy Friday.
Happy Friday to you. Thanks for having me.
What has been the JPM playbook so far, and is it playing out in these early days the way you saw?
Yeah, our view is that the aggressive action the Fed took last week by cutting 50 basis points intra-meeting has set the stage for another aggressive set of cuts. The other times where the Fed has cut rates inter-meeting, it's followed up with another aggressive cut at the next meeting. So we're looking for the Fed to actually lower rates by 100 basis points next week by the Wednesday meeting. One, because of the follow-up on the inter-meeting basis, but second, because in a world in which interest rates are so low, the Fed is supposed to use its bullets rather aggressively. So we think it makes the case to aggressively go to zero next week. And if you look at how rates markets have reacted, the Fed funds market now is expecting the Fed to cut rates to zero very shortly. And the way the yield curve is steepening seems to be reflective of that as well.
All right. So once we hit the lower bound, then what other tools would you expect them to go to first?
Yeah, when you look at the Fed's playbook, it's told you that it will go to zero quickly. It will then use forward guidance to convey to markets that it will remain on hold as long as it needs to. And I think the thing that they're looking at now are probably inflation expectations, because we know market-based inflation expectations have fallen pretty sharply. They're sitting near their lowest levels of the last decade, and the Fed is trying to sort of maintain credibility for its inflation targets of saying that it will not raise rates until those inflation expectations and inflation are back above target is a credible sort of way it could sort of convey this to the markets. And then finally, the question is whether the Fed uses asset purchases again. You saw what the New York Fed announced yesterday. It took its T-bill purchases and pushed them out the curve to sort of alleviate market functioning stress. But the question is whether it makes larger use of asset purchases in order to help reduce dislocations, which are historically high in the Treasury market right now.
Jay, there are people who say that the half-point cut from the Fed was too soon, that it didn't seem to have that much of a market impact, and will question how many resources the Fed will have remaining really should more shocks occur. Why are those people wrong to be concerned about that?
Well, one, I think the Fed has told us that in a world in which it doesn't have much room to ease, it's got to ease aggressively. And we at JPMorgan think right now that the U.S. economy is in recession in the first half of the year. So they're justified in acting aggressively. And yes, they've got limited tools with respect to traditional monetary easing, but they've got other non-traditional tools that we just talked about. But I think this also makes the case that you need to see a policy response from others.